Hi guys, welcome back to the channel. There's a lot of talk about Rowe Price as being a very good option for investing. And I've made one video in the past on Rowe Price. And as you guys know, I'm big on low costs because the only thing you can control in investing is the amount you pay for the funds that you use. So let's take a look at some Rowe Price funds really quickly here. Now we're going to go to their stock fund page because stocks are how you make money. And we're going to scroll all the way down. Now let's take a look at over here on the right column. You see the expense ratio right there. The first is the gross and this is net. Now I like looking at the gross because really that's what you're going to pay overall. Look at this global value equity fund, 3.93%. You guys, that's ridiculous. That's not that one we're going to look at. The one we want to look at here, and I'm scrolling down slow, is called their Total Market Equity Index. Right here, ticker symbol POMIX. If we look at the expense ratio down here, it's 0.22. All right, as we said, POMIX. And this is investor shares. Let's take a look at the investment objective first of all. The fund seeks to match the performance of the entire U.S. stock market. The fund uses a sampling strategy, investing substantially all of its assets in a broad spectrum of small, mid, and large cap stocks representative of the S&P Total Market Index. The fund does not attempt to fully replicate the index by owning each of the stocks in it. So while it is an index fund, it is varying a little bit by not owning all the stocks in that index. So let's scroll down here really fast and take a look at how it's done over time. Now, this fund has been around since 1998, but they're showing for the last 10 years. So basically from 2012 through now, 2022. If you had invested $10,000 in 2012, currently you'd have about $44,000. So you've about 4x your money, which is pretty good, right? But as we know, we've been on a 10-year bull market. So if we look at the normal here, you see that 2015, which was a flat year, didn't do much. And 2018, because of Q4, actually lost 5.5%. But that is pretty standard in all of your funds, right? Let's take a look at the portfolio breakdown a little bit here. So we see that it's 99.3% domestic stock. Does have a little tiny position of cash and a minuscule amount of other stocks. If we look at the top 10 holdings, these are companies we all know: Apple, Microsoft, Alphabet or Google, Amazon, Tesla, Meta Platforms. Meta Platforms, you guys, is Facebook and Instagram. They changed their name. Nvidia, Berkshire Hathaway, United Health Group, JP Morgan Chase, all companies we know, right? Those are. Now, this fund does have a total of 1,223 holdings. The fund manager here is Neil Smith, and it looks like he has been around at Rowe Price since 1994, so for a long time tenure there. If we look at the sector allocations here, we have information technology makes about 28%, healthcare 13.25%, consumer discretionary is about a little under 12.5%. Financials are about 11%. Communication makes up a little over 9%. Industrials and business services about 8.75%. Consumer staples a little over 5%. And then real estate, materials, and energy make up the last about 10%. As we said, it's about 99.3% here in the good old US of A. So these are mostly domestic stocks. Now, really, I wanted to take a quick look and show you why I think it's important that we use cheap funds. Okay, you guys, so here we are. This is nerdwallet.com, and this is their fee analyzer tool. So let's say that we decide we want to use that fund. So remember, that's 22 basis points, so 0.22. But let's say that we initially invest $50,000, okay? And then we decide we're going to do $10,000 a year, And let's say we have 20 years until our retirement. We're at 7%. And as we said, the expense ratio is 0.22. Okay. Now let's say that we have another fund that is, we don't want that. Let's say we have another fund that's 0.5%, so 0.50. Now let's just take a look and see what the difference is in those two. Now remember, this is over a 20-year period. So if we look at the differences on 20 years, first of all, let's look at the amounts that we have. In Fund 1, remember, we're just talking fees here. In Fund 1, we would have $575,300. In Fund 2, we would have $553,000. Now let's take a look at how much we lost in fees, you guys. On Fund 1, we paid about $18,000 in fees. Fund 2, which is just a little over double the cost, we spent over $40,000. And the difference in the amount that we ended up with is $22,000. Now let's say that we went with an active managed fund. Now there are lots of active managed funds, and let's just say that this one was 0.75%, right? And let's do the same exact experiment again. If we look here now, the difference is double. It's 41,000. You guys, it's not uncommon that when you get into these systems, you might, and then let's say that you pay a 1% charge for having that money manager take care of your money. Now let's take a look. Now the difference is $110,000. That's crazy. For me, if we're going to go for a fund, we want to go with one that's low cost. Now let's go back here. Let's take a look again at their stock funds. Right? Now let's go down to the bottom where we have just good old fund. So here's an example, large cap core fund. Now I imagine that's going to be mostly, they're going to be large cap, right? They're going to be big. Fee cost here, 0.73. And I think if we compare, if we go back and we add that in to our other fund, let's go 0.73. It's going to be pretty similar in the way it actually comes out, but look at that, almost $40,000 in fees, you guys. So I think Rowe Price has some good funds. I'm not bashing them. If you look at this difference, for example, this says on the fund that we're talking about, the total equity market has had 8.85 since 1998. Okay. That other fund has 15.5, but it's only been around since 2009. So you have to take into the fact that if you look at this, for example, the 10-year for the equity was 16.03, and down here the 10-year was only 15.9. So it's actually beaten it over the last 10 years, and we've paid a third of the money in fees. Now again, this is just one sampling of fees, you guys. And I'm not bashing Rowe Price at all. They have a good record, but it gives you an example of why saving money on fees can really help the bottom line. I hope you guys got something out of this. If you did, do me a favor. Drop me a like. It really helps the algorithm. If you're not already subscribed, you know the deal. Hit the red button, ring the bell, and we'll see you again. Thanks.